Hello, everyone, and welcome to Wholesale Change. It's the webcast and podcast from Distribution Strategy Group, where we offer thought leadership for wholesale change agents like you. My name's Ian Heller. I'll be your co-host today, along with my business partner, Jonathan Bide, who's not only a PhD, but he's the #1 fan of the 2023 NBA champions, the Denver Nuggets.
Yay.
You having a good week, Jonathan?
So far, it couldn't get better. There's nothing that could mar this week.
Yeah, right. And you're going to the parade tomorrow, right?
Indeed.
Well, that's exciting. I'm excited for you. It's a heck of a year. I guess it's been 47 years since the Nuggets formed, but it's been like 57 because it used to be the Denver Rockets in the old ABA, right?
That's right. But not one, not two, not three. We're looking for 4 or 5 championships. So let's go.
I hope you're right. Good. Okay, well, we're delighted to have a great guest in today. We'll introduce him in a few minutes, but first of all, got to do just a little bit of business. We got to pay the bills, Jonathan. So the first product was actually invented by Jonathan, and it's called Customer Experience RX. It's a subscription net promoter score tool. Smart distributors know that increasing customer loyalty leads to growth in both revenue and profitability. Furthermore, increasing loyalty depends on being able to measure customer satisfaction and improve the customer experience. Our Customer Experience RX system provides a new and exciting way to measure overall customer satisfaction, or NPS, but more importantly, to understand the underlying drivers of customer satisfaction and customer experience so you can actually act on the things that you need to improve to drive up your NPS score. Or if you are using Net Promoter Score, or if you're looking for a way to systematically improve customer satisfaction and customer experience, reach out to DSG. We can help, right, Jonathan?
Absolutely.
Good. That tool's been a big hit. I'm glad you're my business partner. You make me look smart.
Well, feeling is 100 times mutual. Anything good I learned about distribution and marketing, I learned from you. So,
and the bad stuff too, I'm afraid. So
not much of that.
So Wholesale Change is also brought to you by Epicor. Epicor has been a long-term sponsor. We really appreciate their support. And Epicor is a software company that has helped thousands of wholesale distributors for over 50 years to integrate their business functions into one ERP system. Because of their deep experience in distribution, they understand your world and your unique challenges. Epicor helps companies consolidate systems and processes into one ERP that is ready to use out of the box and allows for long-term growth. If you're considering an acquisition or are in the midst of one now, you can learn more about Epicor, at epicor.com/distribution. Epicor, thank you very much. Another sponsor, White Cup. They sponsor a lot of our stuff, Jonathan. We love working with these folks. They're good people with a great product. White Cup believes distributors win more with data-driven technology because the right technology increases revenue and builds sustainable profits. Distributors need tools that use data to make selling smarter, faster, and easier for their teams. White Cup CRM, BI, and pricing solutions are built specifically for distributors, provide access to intuitive automation, and are integrated with your ERP. Set your sales team up for success with White Cup. Visit whitecupsolutions.com. That's whitecupsolutions.com to schedule a free 1-hour sales consultation with a team of experts to evaluate your current sales process and talk through actionable steps you can take to make changes that will increase revenue and profits using data analysis techniques and more. I hosted a user panel for them, and boy, those people love that product.
They've really put together something very, very special, and we know this from the companies that we work with that are using it. So,
I know, we're so lucky to work with such great sponsors.
Yep.
Okay, let's bring in our guest. We're delighted to have on the show today Newton Sears. Newton is the managing director of Greenhill Company. Newton, welcome to Wholesale Change.
Hey guys, I'm glad to be here. And look, I'm a big sports fan, so I can't let that Nugget shout out go just totally in and out. What a time for Denver sports. The Avalanche last year, now the Nuggets, a new football coach, a new coach for the CU Buffaloes as well. It's exciting times for the state of Colorado.
Well, Newton, as somebody who lives in Chicago and who went to school at UNC Chapel Hill, you are well credentialed in making that comment.
I appreciate that, but when I let people know that I grew up in Buffalo, New York, they're going to know that there's a little bit of a sports curse hanging over my head. But look, the Cubbies got it done 7 years ago, so maybe the Bills are not too far behind.
They're close, man. They're a heck of a team. We love your quarterback, and we went to Wyoming, which is close by. So,
yeah.
Well,
I'm delighted to be here. As I mentioned, I'll just give a quick little background on myself, and then also for my firm, Greenhill. So, as I mentioned, I grew up in Buffalo, New York. I went to the University of Pennsylvania for undergrad, and then North Carolina, Chapel Hill, shortly thereafter for my MBA. Since getting my MBA about a decade ago, I've worked in the investment banking industry, and I've always had a focus on the broader industrial sector, and I've been based out of Chicago the entire time as well. Over time, that work has become increasingly focused on industrial services business, as opposed to manufacturers or OEMs, and one of the specialties I've developed is advising companies in the distribution industry, and that word advising is where Greenhill comes in. Greenhill is a boutique investment bank that focuses exclusively on advisory. Or for the purposes of your audience, we advise companies, owners, investors on buying and selling businesses, as well as helping them think through the optimal way to capitalize their business. So if a company is evaluating a financing structure for its business, like a big dividend recap, then we have a lot of expertise to lend in that case too. Greenhill is just a little different from some other investment banks that your audience might be familiar with. Our sole focus on advice has resulted in us being true specialists in the practice of M&A, but also more broadly in helping businesses and owners maximize value. If I were to make an analogy to the distribution industry, it would be that the actual SKU that we sell is the advice being provided during a sale or acquisition. But like a lot of value-add distributors, we wrap a lot of other ancillary advice around just the sale or acquisition of a company. Or in the case of distribution, it could be design or installation advice around that SKU, and that ultimately the relationship with the customer is geared toward helping them maximize their outcome and ultimately create value no matter what. I'll quickly clarify that we work on the sell side with sellers, we work on the buy side with acquirers, and with company types ranging from family-owned to large multinational publicly traded companies. Our ability to provide advice cuts across all types of businesses and situations, so I wouldn't be surprised if your audience could find a lot of relevance in the work that we do.
Yeah, in fact, you guys advised on the Distribution Solutions Group acquisition of Hisco on the Hisco side, right?
That's right. We worked with the team at Hisco. They recently completed that transaction. We have some other relevant experience as well, working with Motion Industries on their acquisition of Command. So we've had a lot of fun working with these management teams and with the owners and investors. These are all great people who have achieved excellent outcomes. So we're just really, really happy to work with the clients who we've worked with.
Newton, a couple questions that perhaps are in the minds of some of our audience. Can you contrast what you do in the IB world with what the private equity PE world does?
Yeah, sure thing, Jonathan. So I think the most significant difference is that we are not investing into businesses. We are not lending them money. We are not investing equity into them. We do not take ownership stakes in businesses. What we do is, as opposed to that, we're really focused on transactions, and when a seller or a buyer needs advice on how to best execute that transaction. So that's I said that's the SKU that we sell. I think that's the principal difference between private equity. We're not lending or investing equity capital. We are providing advice on transaction execution.
And when you describe it as a consultative model, are you also essentially helping to market when you're on that sell side, the company?
Oh, without a doubt. And it will start before then, Jonathan. Whether it's with a buyer or a seller, we're staying in touch with our contacts in the industry constantly to keep them up to speed on updates they should know about, and also really thinking about their business. What are their strategic priorities, and how do mergers and acquisitions fit into that? But yes, when we're working with a seller, we are 100% helping them market their business. And I think we'll get to this topic later, and really make sure that we're covering off on the topics that buyers care about, and also helping them prepare for things that are inevitably going to come up in a sale transaction.
We've talked about this with our audience before in the whole M&A world, the concept of platform versus add-on. So you're representing the company that is selling to the platform in most cases. Is that what I'm understanding?
I think they're representing acquirers too. Is there much of a...
It's really either, it will be either or, Jonathan.
Okay.
I think, everyone has their own definition of platform, but we really do work on any and all types of transactions with buyers and sellers, as Ian mentioned.
So I'm curious, Newton, how is industrial distribution viewed in the capital markets?
Yeah, well, that's a topic that I was really excited to talk to your audience about. So when we're thinking about the capital markets, this is just sort of the world of debt and equity and its relationship with the industry that you focus on. That was something I wanted to touch on. Distribution is obviously a massive global market, and here in North America, very large as well. I think the role of the wholesaler has a long history, has matured over time to a point in which they're a critical part of the existence of their vendor and customer partners. So that long history of the business means that the industry itself is very familiar to the world of capital providers, or what I'll call the capital markets, and the individuals and institutions who are allocating equity and debt capital to different business enterprises. The capital markets know and appreciate the importance of the distribution industry. So why is that important? I think in the equity capital markets, what that means is there are a lot of public and private equity capital that has been allocated to the industry. There are plenty of large publicly traded distributors, so distribution businesses who IPO'd at one point in time and have been successful enough to remain public. In the private equity world, there is, of course, a very broad universe of distribution businesses that have attracted private equity capital over time. That whole trend is, probably a whole different topic, but it's worth appreciating the fact that if you're an operator or owner of a distribution business, there's a high likelihood that private equity capital would be interested in investing into your business. Equity investment into this distribution industry is pervasive at this point. And just briefly on the debt capital market side of things, the credit worthiness of distribution businesses is well known, at least in my opinion, whether that's in the world of the syndicated debt market, so really large companies who are issuing bonds into the institutional debt market, or large leveraged loans, or even at the commercial banking level where a regional bank is providing a line of credit to a distributor so that there can be investment in working capital. The distribution business is tried and true, so much so that the lending world doesn't have to learn it from scratch. Yeah. And of course, there's also cash flow dynamics to distribution businesses that are somewhat countercyclical. And I think the so what of distribution in the capital markets is that if you're an owner operator of a distribution business, then attracting equity or debt capital is remarkably valuable. And that isn't always the case for some businesses that might have a social overhang or an environmental overhang, or are just too new or unknown. Distribution owners and operators should feel very confident about their ability to interact, sort of productively with providers of equity and debt capital.
Yeah, so a couple of things. First of all, to the audience, please feel free to use the Q&A button at the bottom of the screen if you want to send in questions for Newton. But Newton, it's interesting because, I've heard distribution accused of being a boring industry, and I've never felt that way, having worked in it for a long time, but it's certainly not a boring industry in the investment banking world.
No, not by any means. There are, if there are fans of Warren Buffett or Benjamin Graham on this podcast who are real value investors, where the value of cash flow is sort of your principal concern, Well, distribution businesses are wonderful cash flow businesses. I think even in times right now where the operating environment feels like it's slower at some points and then really hot, maybe it's been really hot for a couple of years now, quite frankly, and cash is spent on building up working capital. Well, the beauty of a distribution business is if on the sales side of your business, things do slow down a little, you can unwind that working capital and generate cash. So there's nothing boring about that from an investor's point of view. These are really interesting industries, and you'll see in a lot of, I think, marketing documents an hourglass. Of course, distributors are in an hourglass where there's a lot of connectivity to really, really interesting vendors and really, really interesting customers. And it's such a great way to understand what is happening in that barbell as well, to understand what's important to vendors and what's important to customers. So yeah, I'm with you, Ian. I find it to be a really interesting industry.
Well, so basically what you're saying is that distribution is the Nikola Jokic of industries as far as the capital guys are concerned. It's steady but delivers.
Yeah, and humble too, right, Jonathan? I don't think you find a lot of big egos in the industry either. And and I was hearing some of Jokic's quotes. He just seems like as humble a superstar as you'll find.
Yeah, he is the best ever. So let's talk about the state of the M&A market in industrial distribution, top to bottom.
Yeah.
Really love to hear your perspective. These are, for our audience, these are really significant deals that you mentioned. I'm sure they're just the tip of the iceberg of what you guys do. So love to hear.
Yeah, so the M&A market's always really interesting. It's a nuanced topic for sure, but in an attempt to sort of drive to a concise takeaway, here's my personal point of view. Transaction volume is down, but the best businesses can and will transact in this market and not at a discount. Transaction volumes are down for a variety of reasons, whether it's the increased cost of capital that's an output of some of the monetary policy that's been enacted in the last 12-ish months. I think in distribution specifically, there's also been a lot of sort of hot business or, business that is at historical levels, and sometimes buyers want to get a feel for what more normal environments are like. But setting that aside, my takeaway is that the best businesses can and will transact in this market. So, and just let me be clear, high quality businesses that elect to pursue a sale are still receiving robust interest from buyers and are by no means taking a valuation haircut. And just to sort of put a situation around that, if you're in market with a leading business, then you're attracting a lot of interest. Most operators and owners, in my experience, have a good feel for whether they're winning in the market, if they're creating value through their strategic initiatives, and what their perceived strengths and weaknesses would be in the eyes of a buyer. We're always happy to assist an owner think through those topics before they explore a transaction, but in general, if the operator can check these boxes and also feels confident about the near-term business outlook, then you should be confident about taking your business into the M&A market. On the side of transaction volume being down, I think a scenario that's playing out a lot right now and is causing the lower volume is if you're an owner or investor and you know your business is lagging its peers, or the market is, one particular market you're selling into is a little soft, then you're almost 100% not going to explore a transaction. And the reason why is in a frothier M&A market, that business might be able to transact at a compelling value, but that froth isn't quite there right now. But of course, I personally think that that can be a good thing. So what's the glass half full perspective on that? Well, for any business that's in that situation I described, they have time right now to make the effort and execute their way through whatever aspects of their business needs improvement, or allow time for their market to recover. And it's not as if you're missing a market window that you should be pursuing in terms of selling or buying companies. And I just want to make sort of a really discrete example. Let's say that you as the owner operator have always been thinking long and hard about your pricing. So you have some conviction that your pricing model could be more dynamic and ultimately lead to higher profitability. if you're coming to that realization and you're also starting to seriously consider selling your business, then frankly, the very best you will do is likely receive some fraction of the future value of those pricing and profitability improvements. It's just not well developed enough for a buyer to give full credit for. Now, let's say you've put your head down and in the next 18 months, you've implemented a lot of great work around pricing and seen a 300 basis point improvement in your like-for-like gross profit. If you do end up exploring a sale, then you'll likely receive a multiple of that incremental profit as opposed to a fraction of it. So, it's been proven, it's firmly reflected in your historic profitability, so a buyer can give full credit for it. So a quiet M&A market shouldn't be viewed as a definitive negative from the operator's perspective. I think an operator should view it as a time to lean into some of their strategic initiatives and be ready for when they do want to test the market.
I love that perspective. We actually have a question about the work that you do. Someone's asking, they say, look, we're a mid-sized distributor. We do a lot of mom and pop deals. How small a deal are you interested in advising on?
I think it always depends, Ian.
Right.
I don't think I could give sort of a cold, hard rule. I think on average, when we're selling businesses, the value of the business is anywhere from $150 to $200 million, and then it's sort of infinity from there, if you will. But that's been our usual experience is that size threshold.
And when you talk about frothy versus normal versus soft, does that for the most part translate to an EBIT multiple?
I don't think so, Jonathan. Sometimes the frothiness will result in really high multiples because there's just a lot of capital chasing a finite number of opportunities in a frothy market. But this is a soft market for M&A right now. There are deals being done at compelling valuations that 2 years ago you would have been happy with as well, and you could have really leaned into. So I think in some cases when it's a business that has had a lot of capital running after it, then yes, a frothy market can have an impact on the multiple. But I think some of the deals happening right now are proving that if you're a really differentiated, valuable business, you're still going to receive that treatment in this market.
Okay, so let me ask another way then. How would you characterize what frothy, normal, and soft mean, if not EBIT?
Yeah, I think frothy was definitely 2 years ago, and there's all types of sort of monetary and fiscal policy that results in capital chasing a finite number of opportunities. But if I were to just put time windows around that, 2 years ago was definitely frothy. I think in the few years leading up to the pandemic were relatively normal, at least in the industrial distribution world. And the last 12 months have been soft. And the reason they've been soft is the amount of capital at a very high level chasing equity investment opportunities is just not as great as it was 2 years ago. That's a whole different bag of worms, but I think that's a way to put some time periods around normal, frothy, soft, et cetera.
And you mentioned the amount of capital chasing deals in each of these cases. So is that more of the bar for what defines these terms that you use?
I think that's right. And that's not specific to distribution, by the way.
Right.
There are plenty of industries 2 years ago where there was so much capital that needed to find a home. I think we all saw businesses, getting either really large implied valuations or going public at really big dollar figures where you think, wow, I didn't think that business was worth $10 billion or something like that. This isn't specific to distribution. This cuts across all industries and frankly, sort of capitalism in general.
So, we're going to move on now to what buyers are looking for. And we have a question from Ron, who's a longtime listener. When you are evaluating deals, what are the key operating metrics you focus on? Do you look for key investments in technologies, inventory management, KPIs? What makes you walk away? So that's an introduction to a whole new section, which is what are buyers of distribution businesses focusing on?
Yeah, that's a great question from Ron. I think the KPIs will be very company specific. Some that, and look, I'll use just an example because they're a large publicly traded distributor. I think we all see Fastenal's monthly average daily sales metrics. Fastenal is also pretty good about sort of space utilization or profitability per square foot, things like that. But the KPIs will frankly be they will be company specific. But just in terms of what buyers are focusing on, I like to bifurcate that question between what an operating company is looking at and what a private equity investor might be looking at. So, because that's a helpful, I think for your audience, that's a helpful way to think about who's across the table from them and where some of the differences might be. So let's start with, if you're across the table from an operating company, I think the first principles lens that will be applied is always strategic. Does the target company enhance the strategic path that I want my own company to pursue? So just as an example, I could be a bearings distributor that has some legitimate white space in terms of what my business currently offers. Maybe it's white space in terms of a vendor relationship, a regional presence, or a market or a customer. These are the types of criteria that operating businesses as acquirers are evaluating, and frankly, have been developed well ahead of any deal setting. There are corporate strategy folks who spend all day thinking about the best ways to position their business and will approach any transaction with a bit of a preconceived notion about what strategic criteria needs to be met. That's why we have a really fun time, frankly, interacting with potential buyers, understanding what matters to them, and delivering that to a transaction scenario. Of course, it is buyer dependent. That's what makes all these businesses different in some respect. But I think that's the first lens, a strategic lens. The next lens that I think is going to be applied is a concept of accretion and dilution. And, is this target business going to be accretive to my operations, to my financial profile? And if not, how can I price the acquisition to make it more accretive? And here are some of the questions that I think an operating business is going to want to address when they're thinking about, does this target business enhance my own company's profile? Does combining with this target allow me to outgrow the market? Are they actually not growing their business as well as my own? Is there a marketing or e-commerce capability at the target that would meaningfully enhance my own business? Is there a legitimate cross-sell opportunity, so commercial opportunity? Another sort of flip side to that would be, is there a potential to lose a vendor or a customer relationship? How do I make up for that potential lost business? And then one topic that that's always difficult to discuss, but is part of the sort of accretion dilution topic, is where are there overlapping costs that could be reduced? I think given in distribution itself, there's not as many fixed assets as some other businesses, manufacturing business, frankly, even a software business. So fixed cost takeout is not the linchpin of any and all distribution transaction. But I think these are a lot of questions that a strategic or an operating company is going to ask as a buyer. And I'll let you guys interject with any questions before I get into what a private equity investor might look at.
Well, I think an interesting piece in there that you mentioned is, so one idea is, again, whether you're an operator or PE-backed company, you are a platform acquiring another company. So one case is, how do companies benefit from the platform? Another is, how do they add to the platform, right? How do they enhance the platform? So sometimes you could acquire, like your example, you could acquire a company that is excellent in e-commerce, that becomes part of the platform of the acquired company, and then gets spread across to the other opcos that are part of that company, right?
100%, Jonathan. There are, look, in the world of any industry, there are companies that are better at some things than others. And sometimes that can be a really powerful aspect of a transaction. And it can be an e-commerce capability. It could be, honestly, a picking capability, where there's a little bit more automation in the picking capability at the target. And the acquirer thinks, wow, I think I could really apply that to my own business. Yeah, there are definitely instances where the target, beyond just sort of smashing the financials of the two companies together, where the target is making an outsized impact on the acquirer through something unique that they're already doing themselves.
Or it could be a gear line, like a Rockwell distributor, or, hey, I'm trying to get the Schneider line in a certain geography, right?
No doubt. Yep.
Yeah.
We see that. We see that as a sort of strategic criteria quite often.
So, okay, I've got a question about the timing of when people should bring you in, when buyers should bring you.
But let's shift to the PE side though.
That's yeah, I agree. So, but before I wanted to sort of get that out there so I didn't forget it. But so how about if you're across the table from a financial buyer?
Yeah, okay. The financial investor is likely assessing the target business as a platform. You guys have been using that term platform. Mm-hmm. And there are a few areas that may be distinct to that buyer relative to an operating company. So at a very high level, an easy way for a financial investor to earn a compelling return on the investment is to grow earnings faster than their own cost of capital. So if the cost of capital for the private equity fund is 15%, how can I grow earnings faster than that while I own the business? A really, really sort of actionable way to do that is through acquisition. I think that's why you're so used to seeing a lot of private equity investors use an acquisition playbook once they've acquired the platform. Because if you're thinking, oh my gosh, how do you grow earnings higher than 15%? Well, buying a company that's a quarter of the size of your own is a really fast way to do that.
Right.
So that's a path that they can take. And within that, I think the financial investor is going to assess, does this company's product capability or market exposure lend itself to growth from acquisition? Can the existing management team identify and integrate appealing acquisition targets? Those are some key questions they'll be asked. But acquisitions aren't the only way to grow. And maybe the target has a unique organic growth angle. And that's something a financial investor could underwrite for their investment. So then they'll ask themselves, what are the step functions to growing earnings? Who would be interested in acquiring this business once I need to monetize my investment? How does the financial profile of the target allow it to service the debt capital that will be used to finance the acquisition? These are some of the unique questions to a financial investor that I think you'll see relative to an operating company. The operating company will look into this as well, but I think the financial investor, especially if it's a platform, will start with these types of questions as opposed to the operating company, who I think starts with a strategic framework.
Wow. Okay. I don't know what to ask, Jonathan. I think that was pretty clear.
Well, I think for the benefit of our listeners, we were talking a little bit about this in the pre-show. Let's talk about the angle of ESOPs. And I know there are some listeners that are operators of ESOPs here, and you just did a significant transaction involving an ESOP. Curious if you talk about the dynamics of that.
Yeah,
I don't mean that particular deal, but let's just talk about ESOPs in general.
Yeah, so ESOPs in general, I like to think that at a very high level, an ESOP transacting shouldn't be all that different from a non-ESOP transacting, but there will be, just because of the tax code that has to do with ESOPs and things like that. There will be some nuances, and I think the principal nuance is having the trustee bank for the ESOP involved and ultimately needing to sign off on the acquisition. In that respect, Jonathan, it's not too dissimilar from when a public company is sold. When a public company is sold, all the investors need to, all the shareholders need to, sign up for the sale, or, a majority of them need to sign up for the sale. In the context of an ESOP, the trustee is speaking on behalf of the ESOP and will need to sign off on the transaction. So in terms of what the buyer will look at and all those questions that I just ran through, those are going to apply to an ESOP transaction or a non-ESOP transaction. But the trustee bank needing to sign off on it is something that's pretty unique. I think there will also just be qualitative factors to keep in mind. If you're acquiring an ESOP, you'll want to make sure that the sort of employee owner ethos that has probably been a tailwind to the company culture is maintained. And sure, you can't just set up another ESOP, but there are tools that you can put in place, whether it's stock option programs and things like that, to keep that employee owner ethos moving forward. Because I think culturally, it might be hard to point quantitatively to benefits of it, but culturally, the qualitative benefits are probably significant and something that a buyer doesn't want to lose.
Right.
And are there additional fees that the acquirer pays in purchasing an ESOP? Like
no.
The tax side? No?
There shouldn't be. Like if we get into sort of funky tax stuff, it's not a fee actually. Depending on the tax structure of the ESOP, there could be tax benefits to the buyer, frankly, that the seller will want to make sure that they're receiving some credit for. That is nuanced tax law stuff. We should get an attorney on this podcast who can really get into the nitty gritty of that. But in terms of extra fees and things like that, no, Jonathan, I think the first gate you're going to have to go through, other than, of course, the management team and the board being comfortable with you as a buyer, is the trustee's got to sign off on it. That is, and the trustee is thinking about it from a financial point of view. That is what the buyer needs to keep in mind.
And at what point should a company who's thinking of hiring you, on the buy side, get in touch with you? I mean, I'm assuming it's pretty early in the process so that you can understand the business and help them even make suggestions about how to pursue targets.
Oh yeah, it's never too early. It's never too early for us to interact with a potential seller or a potential buyer. I think if you have created rapport and a relationship before the transaction setting, that's always helpful. I like to think that we're pros. We are normal people who can also just be airdropped into a situation and be really respectful of the situation at hand, while also sort of driving to the right outcome. But it's never too early. And frankly, that is what we're doing when we're not executing transactions. We are getting to know buyers and sellers and making sure that we understand what's important to them, so that when we are in a transaction setting, we're sort of solving for the most important criteria and ultimately trying to find these win-win situations in a transaction.
Is there more to say on what sellers should expect to face when they're looking at a
Yeah, for
potential
sure.
sale?
I thought your audience would just be curious to hear about, what are some of the handful of things that you should be prepared to have ready if you are going down that path. I think the first layer of items that should be ready relatively early on in any discussion, and really this just allows a prospective purchaser to apply that first principle strategic filter that I referenced, that some of the stuff to have handy would be which vendors account for the bulk of my purchases, which customers account for the bulk of my sales, what end markets define my top customers, what are some of the operational KPIs that I myself use to track the business. And this is sort of maybe a more boring topic, 5 years of historical financial performance and any forward-looking forecast. And ideally something that wasn't just made for the transaction, but a forecast that you use yourself as an owner and operator to motivate a sales force or create benchmarks, things like that. Those are kind of the 4 or 5 real high-level things to have ready. And for all these items, you should have some qualitative support for why certain vendors are more prevalent than others, what's caused certain movements in historical KPIs or financials, what is being observed in the customers who are most important to the business. These raw stats might take some time to put together in a pretty coherent manner, but the story behind them is going to be really important. So that's the first layer that allows, honestly, for window shopping, which in some cases you'll need to do. You'll need to let some buyers do some window shopping, and these are the types of things that they'll look into. Another item that could take a long time, so it's worth thinking about, even a month before, if you have the capability, would be, I'll call it a data cube, but for all intents and purposes, it's a transaction database. So, and maybe some of the sponsors you referenced at the beginning of the call are helpful with this type of stuff, because it is so data driven. But the high skew and high number of transactions in a distribution business honestly lend itself to a data-driven analytical approach. And I've seen target businesses who do this themselves. They use these data sets to create takeaways for their own business and then take action. But in a transaction setting, a buyer will do this as well. So look, there's a vast amount of transaction data that a distributor will create in any given year. And I think that can be broken down to a lot of interesting fields in the eye of a buyer. So in that transaction database, you'll have, frankly, maybe for almost every transaction, the vendor, the customer, the volume of that order, the price of the order, the carrying cost of the SKU, the gross profit that was achieved on the order, shipping method, cost of shipping, whether it came from a branch, whether it came from a warehouse. Wow. I know it sounds
no, it's great. Sounds like you've done it before.
Well, BC, this is a good tool to have in a sale transaction, because the data speaks the truth, right? And if you're doing this ahead of time, you'll probably learn a lot of interesting things, but it also just makes things efficient in the transaction setting, because a real diligent buyer could potentially want to look into this type of stuff. And if you have it packaged up and ready to go, that's just efficient. And one thing we do try to accomplish is be efficient with the seller's time. It is not lost on us that there's a business to operate. So if you can create this type of data cube ahead of time, that's great. If not, we try to help with doing it real time as well. But that's a really specific prep item that I just want to call out in this setting, because it's something that we've seen can be a differentiator in a transaction process.
So let me throw out a slightly more specific scenario, and this would be probably below the range of clients you would serve. So there are any number of there's a lot of succession going on, right? People with mine and Ian's hair color and quantity are looking to move on, and some of these companies have concluded they just don't have the resources to invest in digital transformation, which is, for even the smallest companies, a 7-digit number, and for other companies it could be an 8-digit number, right? So what do those companies do to prepare to be sold?
Well, I think I mentioned earlier, an owner operator, in my experience, a lot of the owner operators or investors, they're very self-aware of their own business and, what differentiates it and what they would want to improve. So if digitalization is something you want to improve, I think you'll have to be a little self-effacing about that if you're then pursuing a transaction. And it won't be lost on the buyer that digitalization is something that the company needs to pursue, and the cost of that digitalization could end up being reflected in the purchase price, quite frankly. I know I'm sort of being cut and dry about it, but I find that a lot of the owner-operators, frankly, are very self-reflective about their own business and understand these types of things. So if there is a digital initiative that on the company's own dollar, it's deemed not worth to pursue, then you as a seller should probably just be mentally prepared for that cost being addressed in the transaction setting, or a buyer saying, hey, tell us about your digital transformation. How have you thought about that? And the topic will be broached, and the cost of it will be a very real thing to discuss between the buyer and the seller.
Okay, so it could, if I've made the decision to sell, I don't have a next generation in my family to take over, I'm not prepared to take on that digital transformation cost, I might be prepared to take a lower fee because that's going to have to be absorbed by the buyer.
In a very cut and dry sense, yes. I think that's when working with an advisor, whether it's financial advisor or consultant, to really put a fine point on what needs to happen, put real dollars against it and things like that. That's helpful. And look, this isn't, I'm not trying to make it seem like a doom and gloom scenario. When I used to work with manufacturers, if you're a manufacturer selling and it's just well known that you have 3 pieces of capital equipment that have to be replaced, the buyer's going to know that. The buyer is going to sort of reflect the cost of that new capital equipment in its purchase price. So this isn't meant to be specific to distribution. This is a nuance in any transaction.
So someone is asking about how suppliers, so the manufacturers who supply distributors, how they were responding to changing, or how are their responses changing and evolving to M&A. So maybe a little more broadly, how do you take suppliers into account? I know we talked about it a little bit earlier, but.
So in my kind of list of things to have prepared, this is pretty critical, but supplier and customer contracts, of course. So understanding the stipulations in any vendor or customer contract as it relates to a transaction. I don't want to speak on behalf of the vendors. I've seen scenarios where a vendor is happy that the distribution partner has consolidated, and it frankly takes costs out of their own business. If it's one person to call. So I've seen that play out. The role of the vendor will be determined by, I think, sort of what the role of the contracts say. And in some cases, the contract will say, if the distributor is sold, I need to be given a heads up before that's final. If the distributor is sold, I need to provide consent. You as a seller should have a real good feel for that,
right.
As you're embarking down that path, because you'll want to be more prepared for that phone call than less prepared.
So I think part of the question from this person is also, when you have situations where the supplier has either exclusive or just selective distribution, as opposed to like a 3M who sells gobs of products through gobs of distributors. So the scenario is where the supplier has a lot of weight in this.
Yep.
Right.
Yeah. Well, there could be a gray area, Jonathan. So maybe the supply contract does not call out whether consent is necessary or whether notice is necessary, and it's more of just a relationship thing, then the selling company will definitely let the buyer know, hey, we have a really, really critical relationship with vendor ABC. We're going to get far enough along on this where I'll need to give them a heads up for the benefit of the relationship. And we see that happen for sure. If you're exclusive with a vendor, that does not preclude you from pursuing a transaction. That is not the case whatsoever. It's just something that, whether it's by the language of the supply contract that's been agreed to or just relationship based, it's something that definitely needs to be managed.
Perfect. Thank you.
Okay, Newton, anything else you want to say before we wrap up? My head's spinning. That was some fantastic information. Anything we left out of the conversation that you want to contribute?
I don't think so. I should have mentioned at the beginning, my contact info is on the Greenhill website. If anybody listening wants to follow up or ask any questions, I think we covered a lot of interesting ground. Like we said earlier, distribution's cool in my eyes. So I'm always happy to talk about it with others. And we really, really enjoy as a firm working with buyers and sellers and helping them think through what's episodic for their business is sort of our day-to-day, but we really, really enjoy that. And it's something we take seriously. So I want your listeners to know that we would apply that seriousness to any situation, whether it's formal or informal.
And what's your website URL?
Greenhill.com, so an easy one.
That is easy. Great. Okay, well, if you want to stick around for just a second, our audience too, just want to tell you about a couple of upcoming programs. First of all, on June 27th, we have a group of distribution leaders coming together to discuss how to choose and leverage the best ERP for your company. Sponsors for that program will be Infor and White Cup. So that's at noon Eastern, 9 Pacific on June 27th. And then on June 28th, we'll be back on the Wholesale Change show, and our guest will be Brian Keller, who's the CEO of Keller Logistics Group. And he's going to be talking about how to bring it all back to the community. That'll be a great episode. That's brought to you by Epicor. Newton, thanks again for your time. It was a fantastic discussion.
Thank you both. I really enjoyed it. I really love what you guys are doing at Distribution Strategy. So thanks for including me.
You bet. It was a pleasure. Thanks, everyone. We'll see you next time on Wholesale Change.